Another monetary policy review rolls around on Thursday, the 5th of the financial year, the 6th of the calendar year. And got to say, we're expecting a little bit of more of the same at this time's policy. The expectation from most economists is that you'll see another 25 basis point cut. You're at 5.15% on the benchmark repo rate. That will likely get pegged down to 4.9%. That's the lowest since the global financial crisis period. This is also the steepest series of rate cuts in any 12-month period since 2008-9. The macro factors underpinning this rate cut are fairly obvious. GDP growth plummeted down to 4.5% this time around. If you benchmark it to what is considered to be potential output for India, which is 6.5% to 7%, then you know that the output gap is wide. The MPC will probably take note of that output gap and then decide to cut interest rates one more time. There is a change in the inflation situations between last MPC meet and this time's MPC meet. The spike in onion and other vegetable prices has meant that your headline inflation is more than 4%. 4% is the midpoint of the MPC's band of 4 plus minus 2%. So headline inflation is higher, but core inflation has been falling. So the MPC will likely look through this increase in headline inflation, even though got to say that when Shaktikanta Das took over as governor of the RBI, he did say that the legal mandate is to look at headline inflation. He will probably need to caveat this statement if they go in for another round of interest rate cuts this time around. But I think, as we've been saying, yes, rate cuts, but then what? What good are these rate cuts doing? And that debate is not over. Now, you know, the RBI has maintained extreme surplus liquidity in the system in the last few months. There have been times that it's been surplus to the extent of 2.5 to 3 lakh crores. And what that has done is brought down the short-term rates. For instance, if you talk about the T-bill rates, the 91-day T-bill rate was at 1 point below 5%. And, you know, that's below, obviously, the repo rate. Other short-end rates have also fallen. But what has not happened is a drop in the long-term bond yields. And hence, the yield curve in India has steepened considerably. And that's a matter of concern. Bond market participants starting to grumble about this and calling for Operation Twist, where the RBI comes in and buys long-term bonds via their open market operation program. We don't know whether all of that is on the agenda or not. But, you know, that's the money market situation. Obviously, the transmission problem is more extreme in the banking system. And there you've seen very modest declines, even in the one-year MCLR rate, which is 8.80 at the start of the year and has only come down to 8.45. If you look at the weighted average lending rate, actually, the decline is even less notable. So the banking system transmission issues have not gone away either, which is why there has to be some sort of out-of-the-box thinking, perhaps not from the MPC, which has a very narrow mandate of inflation targeting, but from the MPC, RBI combined. Now, what are these ideas? Well, we've got some for you on our website on BloombergQuint. Whether they get accepted or not, you should go and read them. Somajit Neogi of India Ratings has written about whether the calls for an Operation Twist are justified and whether they will do what the markets expect it to do. Andy Mukherjee of Bloomberg Opinion thinks that India needs to get closer to the idea of a QE, but a QE with a twist. So do go ahead and read that piece. And I argue that the MPC RBI walls are actually doing a little bit of damage because financial stability, which is key and flows back into monetary policy effectiveness, is the remit of the RBI, and the MPC has not paid enough attention to it. So do go to BloombergQuint.com, read all of this, and we'll be back Thursday with coverage of the monetary policy.